This chapter 2 explores in detail the rules and calculations underpinning Basel I and highlights their key weaknesses and limitations. We begin by laying out the risk weights that apply to the various exposures. In the 0% risk weight category, we have cash, claims on or unconditionally guaranteed by OECD central governments, including central banks and government agencies. Note here that the list of OECD countries grows with time and does not necessarily include all countries with a very high credit rating. The full list is available at www.oecd.org. In particular, note that Iceland, Ireland, Turkey, and Greece, and most of Eastern Europe are members of the OECD, while Singapore and China are not. So membership is not always a good indicator of credit standing. Next, we have claims collateralized by OECD government securities or by cash. And finally, we have local currency claims on or unconditionally guaranteed by non-OECD central governments that are funded in the same currency. This rule was deemed necessary to avoid penalizing too heavily the local currency government bond holdings of non-OECD banks, especially since those holdings are considered critical to sound liquidity management. But holdings of this kind funded in a different currency do not benefit from the rule. In the 20% risk weight category, we have the following: claims on or guaranteed by banks incorporated in OECD countries. The thought behind this rule is that banks have implicit or explicit support from their governments, so some tie between their risk weight and that of their government is appropriate. Next, claims on or guaranteed by other banks with a residual maturity of less than 1 year. These types of short-term claims benefit from a reduced risk weight given the critical role they play in short-term interbank funding, trade finance, and other low-risk cross-border activity. Next, claims on securities firms incorporated in the OECD and subject to comparable supervisory and regulatory arrangements, including in particular risk-based capital requirements, and claims guaranteed by these securities firms. This rule is intended to remove the competitive disadvantage of appropriately regulated securities firms versus banks. But note that the US regulators never accepted this rule and continued to apply a 100% risk weight to domestic and foreign securities firms. Next, claims on multilateral agencies such as the IBRD, i.e. the World Bank, the EBRD, the Asian Development Bank, or the Africa Development Bank, and claims guaranteed by or collateralized by securities issued by such agencies. While this rule does not specify clearly that securities means debt securities rather than equity securities, we believe it is intended to apply to debt securities exclusively. And last, claims on or guaranteed by OECD, county, state, and municipal governments. This category includes the massive U.S. municipal bond market, as well as financings of highways, bridges, and other infrastructure that are guaranteed by the local authority. In the 50% risk weight category, we have performing loans fully secured by residential property that is or will be occupied by the borrower or that is rented. Local regulators are authorized to restrict this rule as they deem appropriate, either by limiting the loan-to-value portion of the loan that can benefit from this rule, or by requiring the loan in question to have the first claim to the underlying collateral, or in other ways. Finally, in the 100% risk weight category, we have all other claims not qualifying for a lower risk weight, including especially claims on commercial enterprises, i.e. corporations, irrespective of credit rating. Note that this category contains a huge percentage of typical bank exposures, including unsecured loans to corporates, SMEs, and individuals, and even many secured loans where the collateral is not in the form of cash, securities, or residential real estate, including commercial real estate loans and automobile loans. Next on our list is the determination of credit conversion factors for off-balance sheet exposures. Again, these fall into one of four categories, being the same: 0, 20%, 50%, and 100%. Although you will shortly understand that these four numbers are combined with the four possible risk weights to derive the risk-adjusted asset for each off-balance sheet position. Having a 0% credit conversion factor are the following items: lines of credit, also known as commitments, that can be unconditionally canceled at any time. The thought behind this rule is that the bank can cancel the commitment to a deteriorating credit before it is drawn further. Any amount previously drawn would of course have become a balance sheet asset already, so would be treated in accordance with the rules we examined previously. We also have in this category commitments, i.e. lines of credit, with an original maturity of up to 1 year. This rule is less easy to justify and in any event has been modified under Basle II. Its prior existence essentially reflected a reluctance among market participants and regulators to discourage banks from providing standby credit lines, especially to backstop borrowers' commercial paper programs. A 20% credit conversion factor attaches to short-term, self-liquidating, trade-related contingencies, such as documentary letters of credit collateralized by the underlying shipments. This rule reflects the excellent payment history of this asset class, even in situations in which countries are experiencing distress and are defaulting on or rescheduling their other external debts. In the 50% credit conversion factor category, we have three principal items. Commitments with an original maturity of over 1 year. This category includes typical syndicated loan facilities extended to borrowers for working capital purposes, for specific acquisitions, or for any other purpose. Note again that any portion of the facility that has been drawn already counts as an on-balance sheet loan and is subject to the earlier rules. It is only the undrawn, unutilized portion of the facility to which the CCF of 50% applies. The reason for applying a CCF of 50% only instead of 100% stems from the ability of the lender to invoke covenants and other conditions in the loan documentation to deny funding to borrowers whose credit is deteriorating. Empirical evidence confirms that these types of clauses reduce the amount outstanding at the time of default to a fraction of the total availability, not too far from 50%, according to many studies. Next, we have note issuance facilities and revolving underwriting facilities. These types of facilities include a commitment by the bank to purchase notes or bonds issued by the borrower on predefined terms, and so are very similar in essence to standby credit commitments. And the third item in this category are certain transaction-related contingent items such as performance bonds and bid bonds. These are commitments issued by banks to support payment obligations made typically by corporates in connection with construction and similar projects. If the corporate fails to meet a defined obligation with regard to the timing of completion or the quality of construction, for example, the counterparty can draw on the bank's commitment as a form of penalty imposed on the corporate under the contract. In the 100% CCF category, we have direct credit substitutes, such as general guarantees of debt, including letters of credit serving as financial guarantees for loans or securities. This clause essentially treats credit guarantees as equivalent to on-balance sheet exposures. It essentially deprives banks from the opportunity to achieve capital relief by guaranteeing debt held by another party rather than extending the debt directly. We also have in this category sale and repurchase agreements and asset sales with recourse, where the credit risk remains with the bank. This clause in essence treats a sale with recourse as not a true sale at all and shifts back to the seller the credit risk of the asset sold. This leaves one huge category of off-balance sheet items to discuss: derivatives. Basel offers two alternative rules to deal with derivatives, but the one adopted in most countries and by most institutions converts the notional amount of each derivative contract into its current fair value plus an add-on factor specified in the rule, which reflects the potential future exposure over the remaining life of the contract and depends on the nature of the underlying, and specifically its likely volatility, and also on the residual maturity of the transaction. The add-on factors are listed in the table appearing next and are pretty straightforward. Note in particular the very low entries, turning now red, for interest rate derivatives, even those with a long tenor. The separation of commodity derivatives into gold, which is treated like a foreign currency, precious metals, and other commodities. And finally, note the absence of any mention of other types of derivatives, including, most importantly, credit derivatives, which were little known at the time of Basel I, and for which specific rules have been incorporated into Basel II, which will be discussed in a dedicated module on this topic. We are now able to calculate for any institution its aggregate risk-weighted assets and proceed to illustrate this via an example in Excel on this worksheet Basel I. In column B, we list and describe the bank's assets and off-balance sheet items and show their principal or notional amounts in millions of US dollars in this column C. Note in particular the 7-year interest rate swap with HSBC, which has a notional of 80 million but a current positive fair value of 6 million. Turning to the credit conversion factors, we note the 100% that applies to financial guarantees, the 0 that applies to the 364-day line of credit to Exxon, the 50% that applies to the 3-year Exxon committed line of credit, and finally the 1.5% that applies to the IRS with HSBC, given its 7-year remaining maturity in accordance with the matrix we showed a little while ago. Risk weights appear in column E and are pretty straightforward. Note in particular in cell E8 the 100% that continues to apply to the secured corporate loans, since the collateral is in the form of inventory and accounts receivable, items that generate no benefit to the lender under the rules. The 0 that applies in both cell E10 and E14, given the presence of OECD government securities as alternatively the underlying exposure or the collateral for the underlying exposure. And finally, the 20% that applies to the line of credit to Barclays, which will be combined shortly with the 50% CCF from cell D24. Column F, finally, proceeds with the calculation of the risk-weighted amount for each exposure via simple calculation and multiplication in most cases. For the off-balance sheet items, such as the line of credit to Barclays, note that we multiply the notional amount first by the appropriate CCF and then also by the appropriate risk weight, resulting in a risk-weighted asset equal to only 10% of the original amount. The IRS requires a little further discussion. In the formula in cell F26, we have converted the notional amount into its credit equivalent by multiplying it first by its CCF, then adding the $6 million current exposure of the IRF, i.e. its fair value, to this amount, and only after that we have multiplied by the 20% risk weight applicable to OECD banks as counterparties. Cell F28 finally sums all numbers in the column immediately above to reach an aggregate risk-weighted figure of $309.44 million for the entire institution. Note that this is only some 40% of the total amount of on and off balance sheet exposures appearing in cell C28, a direct result of the application of CCFs and risk weights smaller than 100% in several instances. The last step in our calculations takes us back to the equations for minimum regulatory capital, which, we remind you, must satisfy two main criteria in particular. Tier 1 capital must equal at least 4% of aggregate risk-weighted assets, so 4% times 309.44 million, so $12.38 million if we round to 2 decimals. And the sum of Tier 1 and Tier 2 capital must equal at least 8% of aggregate risk-weighted assets, so $24.76 million. This brings us therefore to a discussion of bank capital and its two components. The separation of bank capital into its two tiers, sometimes called core and supplementary capital, reflects the regulatory view that certain instruments and items are more permanent and more capable of absorbing portfolio credit losses suffered by the bank than others, so that a significant portion of a bank's aggregate capital must be in the form of the more reliable or core capital instruments. Tier 1 capital is defined to include common stock, retained earnings, non-cumulative perpetual preferred stock. The first word referring to the fact that any unpaid dividends must be foregone completely and not subject to a later catch-up obligation. And finally, certain forms of complex hybrid instruments that have mixed characteristics of debt and equity, but are deeply subordinated and long-dated and have discretionary coupons. This last category of instruments is subject to a cap of 15% of Tier 1 and will be discussed in detail in a later module called Hybrid Capital. Tier 2 capital is defined to include various forms of reserves, including general loan loss reserves that have not yet been allocated to any particular credit exposure. Other types of preferred stock and hybrids not counted in Tier 1, and, very importantly, subordinated debt that has a minimum maturity of 5 years and whose documentation does not permit acceleration by its holder except in the case of bankruptcy or liquidation. We mention finally that the rules require a number of items to be deducted from capital, the most important of which is goodwill. The bank in our earlier Excel spreadsheet, for which, we remind you, we calculated a minimum Tier 1 capital requirement of 12.38 million and an aggregate capital requirement of 24.76 million, could, for example, meet these two requirements by structuring the right-hand side of its balance sheet as follows: 300 million in deposits, which get no capital credit, another 100 million in the form of senior unsecured bonds, which again get no capital credit, reaching so far a total of 400 million, 10 million of 10-year subordinated debt, which are classified as Tier 2 capital, 5 million of hybrids, which we will assume here are classified as Tier 2 capital, bringing the aggregate Tier 2 capital to 15 million, 5 million of non-cumulative perpetual preferred stock, classified as Tier 1 capital, and finally 20 million of common stock and retained earnings, also counting as Tier 1 capital, and bringing the aggregate Tier 1 capital to 25 million, and the total capitalization, or right-hand side, of the balance sheet to $440 million. We thus calculate the bank's Tier 1 capital ratio to be 25 divided by the total risk-adjusted assets of 309.44 million, i.e. 8.08%. And similarly, we calculate the bank's aggregate capital ratio to be 40 divided by that number, equals 12.93%. These ratios are actually pretty typical of large internationally active banks in most major jurisdictions. You should have noted that we have set the size of the balance sheet's right-hand side to be $440 million, an amount equal to the aggregate amount of all on-balance sheet assets listed in our worksheet. while the denominator in both is simply the aggregate risk-weighted asset figure calculated in the worksheet. We conclude this chapter by pointing out the principal weaknesses and inconsistencies of the Basel I regime, many of which drove the decision to replace Basel I with Basel II. 1. Exposures to OECD countries in any currency other than the local currency, and only to those countries, carry a risk weight of 0, otherwise 100%, irrespective of the credit quality of the country. Thus, AAA Singapore has a risk weight of 100%, while BB rated Turkey carries a risk weight of 0. Second, all unsecured corporate exposures, and even all secured corporate exposures, except for a limited category of collateral, carry a 100% risk weight, again irrespective of credit quality. Thus the rules treat AAA rated corporates the same way as CCC rated ones. Third, bank exposures less than 1 year long have a weight of 20%, irrespective again of credit quality or country of incorporation. Not only does this again fail to differentiate between HSBC and Lebanon's Jamal Trust Bank for tenors below 1 year, it also leads to the absurdity that short-term unsecured exposures to Exxon have a 100% risk weight, but only a 20% risk weight if they are guaranteed by Jamal Trust. 4. Exposures to multilaterals like the World Bank and the EBRD carry a higher risk weight than those to Turkey, Greece, and Ireland, all members of the OECD. 5. Credit lines, even committed ones, with an original maturity of 364 days or less, have a 0 credit conversion factor, and therefore 0 capital requirement. 6. Residential mortgages generally carry, for the most part, a 50% risk weight, with no differentiation based on the loan-to-value ratio or the underwriting standards. Note that subprime U.S. mortgages are treated the same way as prime high-net-worth mortgages, although the rules leave some discretion to the national regulator to modify this standard to reflect perceived differences among types of mortgages. And seventh, and last, an unsecured bond issued by Exxon, say, and owned by Barclays, requires a total capital allocation from Barclays of 8%. The same Exxon bond, owned by Barclays, but guaranteed by BNP Paribas, let's say, now requires 8% capital from BNP Paribas under the direct credit substitute concept for off-balance sheet items, and another 1.6%, 20% times 8%, capital allocation from Barclays itself, in view of the OECD bank guarantee. So a total of 9.6% across the two banks in aggregate. And yet, the amount of credit risk in the system in aggregate has remained the same. We will see in the next chapter how several of these issues were addressed under Basel II, but for now we bring to an end this chapter 2 of our module, and with it part 1.